we're going to have an all-star list of speakers who were involved in crafting, implementing, altering, amending, and moving forward the Dodd-Frank and the Dodd-Frank world that we've lived in for the past decade, and that world that's going to shape the next decade of financial regulation, markets, and the economy. But we're also thrilled to have everyone here. One of the benefits of a virtual event is the ability to interact easily and quickly. You can ask questions of any and all of the panelists by either using the hashtag on Twitter, Dodd-Frank10, or emailing events@brookings.edu, and we will incorporate your thoughts, questions, and feedbacks into this event live and in real time. I'm really thrilled that we have this event today on the precipice of our 10-year anniversary of Dodd-Frank, because this law is still as relevant as it was the day it was signed and is still the subject of intense debate. Just yesterday, the Supreme Court weighed in with a 5-4 ruling, once again changing and reshaping the parameters of Dodd-Frank. In my opinion, a giant mistake by the court, a show of judicial activism on the right, altering the legal structure and reducing regulatory independence, but there'll be those who disagree. That's exactly why we're gathering people here to debate what happened in Dodd-Frank, what that means for the future. Let me walk through what our all-day agenda and program is going to look like, because you're going to hear from people who really were involved in the core crafting of Dodd-Frank when it was, and discuss the decisions that were being made at the time when the law was being written, and why those decisions shaped our policy response and how they're going to shape the economy going forward and banking and finance for the next decade or decades. Then we're going to turn to the biggest macro question facing Dodd-Frank, and frankly, all of financial regulation post the 2007 and 8 crisis, systemic risk. After that, we're going to turn from the macro to the micro and look at consumer protection. If the financial crisis taught us anything, it's that those two issues, thought to be completely divergent and separate, are really intertwined sides of the same coin. Series of consumer protections and abuses in subprime mortgages and other spaces actually did lead to the systemic collapse of the global financial system, a conversation that if we'd had this event 20 years ago, people would have laughed out of the room as preposterous. Then at that moment, we're going to turn and hear from really the two people who are so intertwined with this law that it goes without saying, they are the law, Chris Dodd and Barney Frank. We're going to turn after lunch, and we're going to have a discussion about the future of financial technology and the implications of Dodd-Frank in the growing, changing world of finance that is often known as Fintech. And finally, we're going to talk about how Dodd-Frank changed the world. America may have led us into the last global financial crisis. We also led us out of it. And this Dodd-Frank Act truly changed global financial regulation. This is a busy and ambitious agenda. We have a couple of coffee breaks and time for people to stretch their legs in between. But we really want to cover the waterfront. Let me pause for a second. I really want to thank and acknowledge the planning committee who's made this event possible. When Amy Friend brought up this idea to me, along with Ed Silverman sitting in the deli almost a year ago, nobody envisioned that we would be having a live virtual event in the midst of multiple pandemics and crises facing our nation. When Michael Barr and Lori Schaefer came and started talking about doing something together and partnering, none of us anticipated that we would be around in this environment. We started talking about, how can we think about Dodd-Frank in this future next recession, which was nowhere near anybody's radar screen. And an event like this doesn't happen without a lot of people. The University of Michigan's Center on Finance, Law, and Policy, their support from the Ford School of Public Policy has been invaluable, specifically the work of Christy Baer, Tracy Van Dusen, Brian Ricketts, Daniel Rivkin, Rebecca Cohen, Julie Lauer, Claire Smith, Jay Campbell, and Gerald Sill. From Brookings, we're incredibly grateful for the leadership and support from our Vice President of Economic Studies, Stephanie Aronson, our communications team, Chris Miller, Shannon Marat, our events team, Anna Dawson, our AV team, Kaylee Baker, who helped organize all of this. It really takes, much like Dodd-Frank took the work of hundreds of people, too many to thank individually, too many to include on this program, but success has many fathers and mothers, and there were many people involved in the crafting of this law. There were many people involved in this program. And on behalf of Brookings, I want to give a sincere thank you. I also just want to make one note, which is that financial regulation can often feel like an abstraction. Concepts involving systemic risk and consumer protection, balancing the value of financial stability and economic growth, trying to create trade-offs, debating legislation that fundamentally transforms the allocation of capital has huge economic impacts. But fundamentally, financial regulation is about judgment. It's about leadership. No law or structure can force somebody to make the right decision. Simultaneously, the availability of credit can be a life changer, providing people the opportunity to do amazing things. The systemic denial of credit can be a crushing economic blow, resulting in decades and generations of inequality and a failure of opportunity. Far too long in American history, we've seen these decisions being made as a result of systemic racism and structural inequality. The movement that's broader afoot, I think, needs to be incorporated into our thinking, because this conference and debate is as relevant a conversation there as it is going to be about climate change, as it is going to be about economic growth and opportunity. Millions of people's lives were altered by the Dodd-Frank Act, and they may not even know it exists. And that's one reason why it's so critically important that we're here today to debate not only what caused us to make those choices, but what those choices mean for the future. I'm going to pause now and introduce a legend in this field, a leader of our nation, a friend and mentor, somebody I was fortunate enough to work for, Senator Chris Dodd. And I want to start with a brief story. I was a chief economist on the Senate Banking Committee, served on the committee for over 8 years, and was fortunate enough to serve under Senator Dodd's chairmanship for a little over 2 of those years. Senator Dodd was only chairman of the Banking Committee for 4 years. During that time, he led legislation that fundamentally reformed the regulation and oversight of the housing market, including Fannie and Freddie, known as the government-sponsored enterprises. He oversaw regulation that fundamentally transformed the regulation of the credit card market. That little plastic square, it's increasingly becoming a digital idea that's in the wallet of so many millions of Americans and in our mailbox almost every day. That was totally revamped how that was regulated under the leadership of Senator Dodd. There was also this small legislation called the Dodd-Frank Act that we're gathering 10 years later to mark. But the story I want to tell is another bill that he passed during his 4 years as chairmanship, known as the Emergency Economic or Stabilization Act, which everybody calls by its first Section 101, the TARP. And I'll never forget, during this debate about how to respond to the economic crisis that was enveloping this country in 2008, there was a moment when things weren't going so well. The Treasury Secretary was still pleased about the failure of Lehman Brothers as a result of promoting moral hazard or discouraging bailouts. Markets were wild and jittery. As many of you may recall, down the road, the House of Representatives later turned down the first bailout. This occurred in the backdrop 60 days before a presidential election, the height of American partisanship. And we had a hearing where the Treasury Secretary was going to make this idea, and we'd already come to the conclusion under Senator Dodd's leadership that their idea of a troubled asset auction program wasn't going to work. And I walked into the hearing loaded for bear with all these questions designed to expose the fallacies of the administration's proposal and promote the ideas of ours. And Senator Dodd read them and he looked at me and he said, "Aaron, do you think we need to pass a bill to solve this problem and for the benefit of our country?" And I said, "Senator, you're right, we probably do." He said, "Are your questions designed to make a bill easier to pass or harder?" I said, Senator Dodd, these probably make a bill harder to pass because they show the problems on the other side. And he said, what are you going to do about that, Aaron? I said, I'm going to go back and write some different questions. And it was Senator Dodd's keen leadership and vision that the goal of creating legislation is not to score points, is not to embarrass the other side or promote your side, even if elections are turned about it. The goal is to do what's right for America and ultimately what's right for the world. And that has left an indelible mark on me. Senator Dodd's work has left an indelible mark on this nation. And without any further ado, I want to welcome and thank Senator Dodd, turn the floor to him to hear his vision for this event and his thoughts about a decade under Dodd-Frank. Senator Dodd, thank you very much for joining us. Welcome and look forward to hearing your thoughts.
Well, thank you, Aaron, very, very much. I almost felt I had died. That was sort of a eulogy, but I thank you for those tremendously generous comments. And you and Amy and so many others we're going to hear from today were involved in both the House and the Senate in putting the bill together. Many of you have heard me tell this story, but it was about 4:30 in the morning on the conference when Congressman Ken Jaworski, we were finishing up the bill, the House and Senate meeting in a rare, something you don't know about today. We'll have to teach students what a conference is between the two houses of Congress. And Congressman Ken Jaworski suggested we name the bill the Frank Dodd bill. And Barney, of course, with that endless sense of humor, said, no, they'll just think it's one guy. He said, and I'll end up being blamed. He said, let's just say we'll reverse that. We'll call it the Dodd-Frank bill. So that's, and Barney and I think both felt that naming the bill for us, in a sense, historically, for some reason, financial service bills historically have had the names of members attached to them, Glass-Steagall and many others that people will remember. But in fact, as you pointed out, Aaron, and you'll hear throughout this day, this was an incredible effort that involved some remarkable people. Names you'll probably never know, in a sense, don't get the attention they deserve for working to make this happen, both within the administration, obviously our staffs, stakeholders, outside individuals who contributed as well. Our Republican colleagues, as you point out, as we talk about today, we didn't end up with a lot of Republican support of the bill in its final passage. But as Amy Friend will tell you, and others, Eddie Silverman, who worked on this bill, Jimmy Siegel, the bill has a lot of input from our Republican colleagues. And while their names don't show up on the day of the final vote, this really was as much of a cooperative effort as we could get at the time. So Aaron, I thank you and for your wonderful support and help in putting this conference together. And you really outlined in many ways what I think is critical. It's really important that we go back. I think historically it's very valuable. How did this happen? What would we do differently? What would we add? What would we take away? There are a lot of those ideas which I think are valuable. And none of us could have anticipated. When you called me, Aaron, and Michael Barr got in touch with us and Amy came up with this idea, we had no idea we'd be gathering in places all over this country. And we'd be in the midst of the worst economic crisis. It makes what we went through in '08 seem pale by comparison in many ways when you realize what's going on globally. And so the timing of all of this couldn't be better. And so I'm confident today, not only will we go back and revisit the decision-making process that led to this result, but as important, in fact, more importantly in many ways, how can we learn from that experience and apply it to this? Because we clearly now, 10 years later, have many more opportunities and so forth than we had those days, 10 years ago, to really step up. We've been given a gift. I know that's a remarkable word to use in the midst of what people are going through with the tragedy of this virus. But we've been warned now, clearly warned, that we need to do things differently if we're going to come out of this economic and healthcare crisis in ways that will allow prosperity and growth and optimism to be restored in the country. So with that, let me just share a few opening thoughts, if I can, in addition to these brief comments. But again, Aaron, thank you for those very generous comments about the work of our committee. It's an honor to join Barney as well this morning and today, and other distinguished speakers and guests we have. Clearly want to thank Brookings and you, Aaron, again, and the team at Brookings, along Michael with the University of Michigan's Center for Finance, Law, and Policy, a great institution combining academics with a think tank like Brookings. I think a very smart idea. Bring us all together and all for the good and thoughtful work that you do and we did to advance that Brookings does all the time in advancing policy decisions, a place where these kind of conversations can occur. I understand as well that we'll be hearing from Glenn Hutchins who's doing great work at Brookings, a remarkable individual and contributes in so many different ways. So I'm excited about Glenn being a part of this effort today. It's important, I think, to review what we did 10 years ago. And as I look around this virtual room, you're going to hear from some remarkable people who can bring great insight to what we tried to achieve. I see leaders who helped our country through an unprecedented financial crisis, who worked with us to craft this legislation. I had an incredible partner, Barney Frank. We had worked together on some issues in the past, but this was clearly a major, major effort for both of us. It was really a remarkable time together. We developed a great friendship, and putting this together, I can't thank him enough, not only for his work, but the work of his staff as well for making all of this come together, if you will. I had tremendous colleagues in the United States Senate. People may have forgotten this, but we literally, Barney and I were negotiating the final vote of Dodd-Frank as the final vote was occurring on the floor of the United States Senate. And this bill became law with the thinnest of margins of any piece of legislation. One vote. Had it gone the other way, we'd be having an academic conversation about Dodd-Frank, not a discussion of what we were able to achieve and accomplish with that legislation. So my thanks to my Senate colleagues, as well as tremendously important to mention. The Obama administration played a critical role, obviously a president who cared about it, a vice president who cared about it, moving us forward. So I'm grateful to them as well. And cared about not only just what we did, but the outcome of the legislation. And again, to the Banking Committee staff in the House and the Senate. It's worthwhile, I think, to look back on what we did. But as Aaron has said, and I've tried to suggest as well, we need to also reflect on where we are at this pivotal moment. And none of us, again, could have imagined, as I mentioned a moment ago, the Navy talked about coming together, and none of us could have imagined what we'd be going through at this very hour and where we're going. So the conference gives us a wonderful opportunity to explore how the lessons we learned 10 years ago might guide us and looking forward and considering the path ahead in this crisis we're in. So much of our lives and the lives of the American people and people around the world have been changed by the pandemic, as we all know. And our expectations have been upended in many, many ways. And we will end up, I'm confident, with a vaccine. But this is not the last global pandemic. All of us now, I think, come to the realization we're in a different world today for a lot of different reasons. And we will cure and minimize the virus. I'm very confident of that as well. But I think all of us in this room, and if others disagree, I'd be anxious to hear why, our economic recovery is going to lag behind, in my view. Even if a virus appeared not for 6 or 7 months from now, getting back on our feet economically is going to lag behind our ability, I hope, to solve the virus or the healthcare issues. We can't do business the way we've done it in the past. It's not going back to normal, whatever that was. That's over. Here we've been given this opportunity, if you will, to understand we cannot do things the way we've done it in the past if we're going to get back on our feet and provide the leadership that we have historically in financial services. Where are we going? So where are we today? If we look ahead, Dodd-Frank has delivered on its promise to create a more transparent, accountable, resilient financial system, one that's being tested by this pandemic, obviously, and its spillover effects on the economy. I believe this is very important to say. I think we'd be in a far deeper mess today had we not done what we did in 2010. Had we not provided the capital, the liquidity, the stress test, all of these other items. Today, our financial services are playing a very critical role in helping us get back on our feet again. Had we been left with a structure that existed in the fall of 2008, I think the problem we're facing today would be substantially worse than it is. And so today we can talk about that, but I believe that very, 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 very sincerely. There's no doubt in my mind that the system today is in better shape to face this crisis and the financial system that nearly collapsed in 2008 from circumstances of its own making, which is very different than the one we're dealing with today. We know well from the financial crisis of 2008 that the health and stability of the banking system is inexorably linked to the financial health of consumers and communities, as Aaron has already indicated. It doesn't take much to understand that we have a long way to go to achieve a financial system that treats all consumers and communities fairly and with dignity, and that the financial health is still far out beyond the reach of too many of our fellow Americans and people around the globe. There's never been more clear than the past few months. Once again, tens of millions of Americans are unemployed. Businesses are struggling to open or stay open. And the Congress and the Fed have been pressed into taking action. Can you imagine if we had said in February, by the way, in a few weeks, the Congress will come together without a dissenting vote in both houses and appropriate trillions of dollars to get going? You would have been considered a lunatic to imagine in this day and age that that kind of an occurrence would happen. And yet we watched it unfold before our very eyes. Across this country and around the world, we see that just having a cell phone, for instance, can unlock access to a banking system previously unavailable, certainly in the days when we were crafting this legislation. Thousands of fintechs, companies that didn't exist 10 years ago, have shaken up banking, the banking industry, by using new technologies to develop and offer cheaper rather and faster and more user-friendly and accessible financial products and services. Banks are learning that technology may help them serve customers that previously were often and that were wrote off previously and should embrace the changes that are ensuring consumer protections and at the forefront of those particular efforts. The use of technology may be one path forward to achieving a more inclusive, fair financial system, which I agree with. And I challenge regulators, as we hopefully will discuss today, to better understand the innovations that benefit consumers and small businesses, to identify impediments to financial innovation, and to establish regulations and encourage such innovation while outlawing obvious abuses. Further, we need to redouble our efforts to ensure that consumers and communities have the essential financial services they need to be productive. And that sentence alone, in my view, could say what we really ought to try and achieve here today in this conference. We need to redouble our efforts to ensure that the financial system lifts up people by offering suitable, affordable, accessible products, and by shunning predatory practices that exacerbate the economic and racial inequities in our country. That again, over these remaining last weeks, we've seen those scars and those inequities exist in our country today and need to be addressed. And while the Dodd-Frank Act was greatly informed by lessons learned from the last crisis, the tools it provided regulators were forward-leaning, in my view. The law encourages regulators to look around corners for the next source of stress to our systems, to share their information and their views with each other through the FSOC, and to ensure that we are appropriately prepared in protecting the financial health of all Americans. Now, we know that not all of the threats will originate from within the financial system. And again, Aaron has addressed this, and really, I hope will be stressed today in our process. With COVID-19, we've seen that a health crisis can quickly spill over into the financial system. And right now, another natural disaster is looming with serious, widespread consequences for our financial system. And of course, I speak of climate change. Policymakers and regulators don't need to wait until a catastrophic act is upon us. Now is the time to be laying the groundwork and thinking ahead. We have been warned. We're seeing it before our very eyes. We don't have to wait to see something unfold, in my view, here to collect the facts and to move forward with imagination about the havoc we're confronting, but also how we can deal with droughts and floods and fires that are going to have a huge impact on agriculture, homeowners and communities, and institutions that finance them and insure them as well. Let me just say to you, and we'll talk about this today. I've often said over the last number of years, we never could have passed Dodd-Frank in 2006 or 2007. And it only took the events of the fall of 2008 to make people realize the occasion. And frankly, we almost waited too long in 2010. We got very close to the point where we Americans think everything's okay, we don't need to do anything. And so I would warn coming Congresses here, don't wait too long to move. We're going to get better and healthier for all the reasons I've mentioned here, but we need to understand what we've been served up here and that we need to address the reforms that can be made to make sure we weather these efforts better. At any rate, these and other challenges will loom large. We got a great opportunity today to talk about them. And the only way we can tackle them is through a collective effort. And Aaron, I appreciate your telling that anecdote and story as we led into the TARP legislation. The answers are not confined to any one agency, to any one institution, one political party. What I learned rather through 36 years of serving in the House of Representatives in the United States Senate is that solutions achieved through consideration of diverse viewpoints, while messy and inefficient and frustrating beyond your imagination, what emerges from that process historically are far more durable and are more widely accepted and will stay with us in the years ahead. So we cannot lose sight of what I've learned historically by going through this very painful process to produce the results. And I appreciate, Aaron, you're talking about the lesson it took me some years to learn as a member of the United States Senate. Meetings like the ones we're having today are worthy for our collective efforts. And so while I'm honored to be here today to look back on what we achieved 10 years ago, I would challenge all of us, those speaking, those listening today, to think ahead. How can we think ahead now for the next 10 years and beyond, to take actions that not only will strengthen our economy and serve communities and minorities in our country, but as we did, and I appreciate, Aaron, again, you're mentioning this, we lead in the world. I don't want the United States to ever have to follow anybody else. We are the gold standard on financial services, and we ought to be deeply proud of that, the success we provided in our country historically in this particular area. And so I want to see the United States lead. That was one of our motivations with the Dodd-Frank bill. So I'm excited to hear today about the ideas, the questions that come up. You've been patient to listen to these opening remarks, but I think it sets the tone, Aaron, for what lies ahead of us. So thank you, and I look forward to the discussion.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.